S&P daily chart, and the reason why we're going to use the daily chart is we're going to take a look at this green line here. Back in 2009, off of the bottoms, when that green line, which is referred to as a 200-day simple moving average, had flattened out, it's a very long-term bullish rising 200-day simple moving average. And it also tells you that when you learn more about moving averages as public indicators, is that longer-term 200-day moving average, it's going straight up the hill and it kind of flattens out, but it never breached it per se. We always got a little bit behind it back in 2010, last summer, but it kept rising, and it's risen all the way up here. So basically what I'm going to do is I'm going to show you, I'm going to clear these trend lines, and I'm going to show you that when the green line here had flattened out, we had rallied back above it right over here, okay? And this was on the S&P back last year, okay? And it was that the S&P simple 200-day moving average had kept rising in value, okay? And it's a long-term rising 200-day moving average that the S&P within this market top correction has been fighting for. Because when you take a look at how long that this 200-day moving average, we can start right over here in 2009. When that simple moving average stopped going down, that's when the markets were putting in a bottom. We rallied above that 200-day moving average for a number of months up until the top of 2010. But nonetheless, even though that we had gotten back below it on a percent level basis, the 200-day simple moving average was still rising and flattening out. And that meant that that S&P was still very strong as understanding how to use public moving averages that lag price movement where your platform doesn't. And I just want people to know that that green line, that 100-day moving average has been rising, that 40-day moving average has been rising. These are long-term uptrends that the bigger institutional traders and hedge fund traders on an intraday level are going to be looking at. Now, it's still rising. That, you know, yes, we got overbought and we called for correction, but the long-term, that long-term rising 200-day moving average is what supports a bull case for the S&P. We bounced off of it. We tested it. They came back in at that moving average yesterday like a bullet. Lots of short covering. That's what that wick is. Huge short covering off headline news. Greece is okay now. Oh, boy. So that's what that was. It doesn't matter. What matters is that the S&P, they keep buying the cover, and when the shorts can't get below that, that's when they buy the cover, and that's where this price action volatility is happening as far as the S&P 500 index goes. And we come down and we test the lows twice. We had a 4-day rally. We had a big gap down yesterday. But look right here very clearly that it does, and this is all short covering yesterday. And it's right here at that long-term rising 200-day simple moving average. That's where the bear, the short seller, when it doesn't break below it, that's where you get these short-term oversold rallies. And when they don't break below it, they buy the cover right there. And now you're at the 10-day simple moving average. So the S&P 500 long-term 200-day moving average rising is why you haven't caved in. Yes, you've corrected off the top. I will tell you, though, the first time that it breaches that, you will sell down. And we're not there because the bigger floor traders, and I'm talking about the biggest money out here, this is going to be the support level when it does break right here. However, the mechanical volatility, price mathematical volatility is that when it doesn't break it, the shorts squeeze up on out. That's why you're getting that bottom up price volatility to go long, and it works real well. So now what you're doing from the top of the short that we called up here all the way down here is how to buy off of that. Then it tested and the bears get frustrated. We take advantage of that bear raid, meaning when they got to buy the cover, we're getting long here on the S&P and the leadership in the S&P and whatnot. And today is 6/24/2011. You have a yearly Russell 2000 rebalancing, 1000 rebalancing. It happens once a year. It just happens to be today. And let us not forget that the Nasdaq comp was the one that led it, but this is the long-term uptrend using that green line there and where them short sellers and price volatility come in. And it's a weekly options expiration.